In your money this week, stocks were slightly positive, although it was choppy, particularly if you include last Friday. Bond yields ticked down a bit, and the May CPI report came in hot but in line with expectations, higher than the prior month, and it's running at 4.2%. Plus, we have a massive IPO this morning. So, we're going to hit three main topics today after digging into some market charts: the latest CPI report, the SpaceX IPO, and what it reveals about so called passive index funds, and why we're growing more concerned about residential real estate. But first, Andrew, welcome back. How you doing, bud?
Doing well out at Laguna Beach for a conference, just grinding. You can't see it, but it'd be a real shame if you guys could hear the waves crashing behind me.
All right, well, check Andrew and his team out at the morning market briefing where they talk about markets every day, podcasts and YouTube. And please hit like on this video and subscribe to the channel for us. So first, let's look at stocks since last Thursday's close. Since we recorded last Friday, right before the market opened, we kind of missed the choppiness of Friday. So I wanted to bring Friday back into it. And you had asked that I add the S&P 500 equal weight index, which simply
Yeah, I was
gives
curious.
yeah, it simply gives each stock the same weight instead of letting the largest companies dominate as they do in a market cap weighted index. So, bringing that up, it's a nice way to see whether this market is being driven looking at the S&P equal weight by a handful of mega caps or whether gains are broad based. So, since last week, as I mentioned, Treasury yields down a bit. The S&P 500 slightly positive. Equal weight did better. Developed international, small caps, emerging markets all did better than the market cap weighted S&P 500. You wanted to add it because you wanted to see if the market was being driven by the mega cap names, or was there anything else?
I think the biggest thing, I think everyone for the last several years has been so focused on the Mag 7, and I think that's fair. I am curious to see if the maybe the basket of names we're focused on is shifting over time, but it's not actually expanding all that much.
Okay.
Um, Week to week, are you going to see that? Not necessarily, but my question would be, are we getting real market breadth
Mhm.
over a long period of time? A broad market, which to be clear, like does not necessarily mean a better market, but it certainly levels the playing field a bit for various strategies to be competitive with the market over time. When the S&P 500 return and the equal weight return are more similar, that's a positive. Candidly, 1% may not stand out to you much as a gap here. Um, but over time, if you compounded a 1% gap, you would have a real theme there that would really impact portfolios.
Yeah, and we probably wouldn't be doing these shows either if we had that 1%
Right.
cumulative difference weekly in our
Yep.
performance. All right, so any thoughts on this, or is it too short term for you to make any conclusions?
I think it's a little bit too short term. Interestingly, though, if you said if you erased the numbers and said this is a 6 month trend between the S&P and equal weight, and you said, hey, the S&P is up, but equal weight is up more, I would generally like that.
Yep.
I would say, okay, great. We've
So
got
we
a broad competitive market.
So we zoomed out a bit. Sorry to interrupt you. Zoomed out a bit. This is the chart we've been looking at from October 2022, the trough, and it. I did add the equal weight. So the S&P 500 up 106%. It's down 2.5% from its all-time high. The S&P equal weight is at an all-time high, but its performance is trailing the S&P. The Russell pretty much at an all-time high. MSCI developed international, the EFI, that's what that is, and emerging markets, very close to their all-time highs, not quite tracking. And the emerging markets is closest in performance to the S&P 500. When you look at this, do you feel like this is still a healthy advance, or are there parts of the market that either feel a little bit stretched or that haven't joined the party yet?
Um, Both, everything you just said. I feel I don't feel at a broad level looking at the market. I do not feel like we are massively overextended. It does not feel incredibly frothy, and a big part of that is even investor sentiment. I certainly would not say that we're in a euphoric state as investors. I do feel like there are components that have run at a rate that seems unsustainable, and the expectation for earnings growth is absolutely staggering. And I also feel like there are companies that really should be doing better in this economic environment, but they've gotten kind of lost in the shuffle. So I feel yes to all of those questions.
Yes to everything. I love it. It's interesting you mentioned euphoria and sentiment. I would say in the client conversations I'm having or the investment conversations I'm having generally, people are nervous. People are a little bit skeptical. I still think of this market, but Schwab shared some data that retail investors have really plowed into this market. So it's interesting that disconnect to me, but I would say based on what I'm hearing and seeing, it's much more why is the market doing this well versus, can you get me all in on this market?
Yep. Yeah. And even at this conference, several representatives from Schwab spoke. They spoke about specifically on the retail channel. They have many businesses. We're more on the institutional side with our custody arrangement. But they said firm wide, the amount of leverage and uncovered options are at an all-time high for the business, but it's especially elevated in the retail space.
Interesting.
So
What does
people
that tell
are
you?
people are taking bets. They're feeling a little bit invincible. I think as professionals, we often like to roll our eyes and make fun of the retail folks, the GameStop bros, and all of those memes. But the reality is they are a massive constituent of the market,
Yep.
and what you can think they're idiots, you can think they're really smart, you can be one of them. Ignoring that class of investors, I think, is foolish. Um, and so I think we have to be cognizant of what others are doing. And it's no different with other investing styles. I know enough about you and your background. You're not a technical analysis guy. Um, we aren't either. We're not looking at charts and saying, okay, here's where we want to be moving 200-day average. That's not how we operate. But we have to be cognizant of that because there are a lot of traders that are trading on technicals and they can move the market. And if we don't know what they're seeing, we're flying blind on at least a portion of the activity that's happening every single day.
So do you think that means there's a buy the dip support from retail, or is it that retail is extremely confident right now and they could be in for a little bit of a rude awakening if volatility and negativity picks up?
I think it's more a confidence and a irrational belief that what I was doing was not working, so I must go all in on something else.
Okay.
And I think that's a bit of a fool's errand. Nothing against, again, nothing against those guys. I hope they make a ton of money. um, but you see that. I mean, you see the volume and the pricing of things like cryptocurrency and what it has done, and it is not surprising to me that many of the people that really poured into crypto are also wanting to pour into SpaceX, which we're going to get to. Again, I hope it goes well for them. I'm not rooting against them, but they are literally moving money, many of them, not all of them, but many of them from one bucket of highly speculative investing to another of highly speculative investing.
All right, so let's jump into the CPI report. So the May CPI report showed headline inflation up 0.5 on the month and 4.2% over the last year. Right in line with expectations, but it's the highest annual rate in about 3 years, driven largely by the jump in energy prices. Core inflation, which strips out food and energy, rose zero point 0.2 on the month and is at 2.9% year over year. So the story is really that energy is reaccelerating while underlying core remains in that, for the Fed at least, uncomfortable high twos to low threes range. Shelter rose 0.3% on the month, Andrew, which I know you don't find credible, and I support that. I understand that. Aside from this, should this report matter much to investors, given that it hit expectations and people know we're in a war that's driving energy prices higher?
That's a great question. I think it should matter in the sense of it confirmed, at least for me, it confirmed a lot of our prior expectations. I think even on this call, we felt like, hey, if the war is close to over, whenever that is, we're going to have two more high prints, and then we should see this normalize. This was not a higher print of data in which we say, oh gosh, we need to rethink things. And the individual components were largely in line. So I think it matters in the sense of, okay, we, at least for 1 month on this one data point, we had a pretty accurate view of this. I don't think it matters though in the sense of having real meaningful implications on an individual stock or a basket of stocks or an index. And I don't know that it really matters a whole lot, even as it relates to interest rates and the rate environment. The market is continuing to react as if it really matters. But I think when you think especially of a new Fed chair coming in, I think we're going to move slower on a rate change than most people generally would think. I don't think we're going to be reactive to this. I don't think we should be reactive to it. I think the Fed's going to want to let the dust settle. So I don't think it's going to drive interest rate policy in a meaningful way. In the past, there have been reports where it's like, oh gosh, this should be spurring action. I don't think this is one of them.
Okay. Yeah, as far as to answer my own question, for investors looking for inflation protection, I think long term, it's still best protected through owning high quality stocks.
Yep.
You can have a small allocation to some alternatives that could help in the short term, like real assets and commodities. But I think inflation protection, comes from portfolio growth and particularly quality companies that can pass on, their costs to consumers and have pricing power. I shared an article about this recently in my Wednesday reading list, and I'll link to it in the comments if people want more on that. And I think bond yields are still attractive, right? High
Yep.
quality fixed income is still attractive in this environment. All right, so let's get to the big one, SpaceX, the IPO. We got the SpaceX IPO this morning. It's one of the most consequential new listings in years. It's the largest IPO we've had, and they're aiming for a valuation of around $1.7 trillion, dollars, which would make it a mega cap stock just from the get-go, just under Apple and Alphabet in size. I know you have a lot of thoughts on this. So I'll start with you on SpaceX, and then I want to transition a little bit into what this means for passive vehicles and the choices that index providers are being forced to make with this start of a few large IPOs.
Yeah, it's super interesting. I think the biggest thing I want to make sure people understand is I think the scale, and not only the scale within uh, all the headlines you're going to read in terms of largest IPO, this, that, and the other, but the scale as it relates to the market, even other companies in there. Last week we talked briefly about Alphabet issuing, essentially $80 billion of shares. Um, if you were not concerned by that, and you want to be intellectually consistent, you should not be concerned about the size of the SpaceX IPO, because what's coming to market right now is, I think, $75 billion of SpaceX. Um, and I'm not saying that you should or shouldn't be concerned, but it's interesting the number of people that I know that were really,
Hey, Andrew, concern from
yeah,
what vantage point?
concerned about drawing cash from other assets,
Okay,
concerned about the fact that, hey, now all of a sudden there is so much more to be invested in,
got it.
concerned with Alphabet specifically about dilution, but with SpaceX, dilution of other assets.
Got it.
And I've heard from a number of people in conversation or on media, it's not like the CNBC didn't call me to talk about it, but I've seen people that have really pumped up Alphabet as an example and said, this is great. This is a really efficient use of their balance sheet. This is a great way to do it. And I don't necessarily disagree with that. And then simultaneously, they are panicking, at least on TV or on the phone or whatever it may be, about how much SpaceX stock is hitting the market. And the reality is these numbers are almost identical. So if you are worried about SpaceX coming in and pulling so much cash from other assets, I alluded to one earlier. I think a lot of money is going from crypto to things like this. If you're really freaked out about that, you should also be a little bit concerned about Alphabet doing the same thing. But the reality is, I think the trading is going to be incredibly fascinating. It's not actively trading yet, which is always, I think, a frustration. And I've heard from a number of clients already this morning that, oh, I thought it would be trading by now, and they don't own it, but they're just curious. It always takes a little bit too long for these things to actually go live. And if you asked me why that is, I don't know. I mean, I know the technical part of it, but I don't know why the ducks aren't in a row and why we're not going somewhere with it. Um, but what's going to be interesting, I think, is the prolonged entry of additional shares, because they're not just coming to the market right now. It's a relatively non-traditional lockup on the SpaceX shares. Notably, Elon Musk owns 40 something percent of it. He has a incredibly long lockup period. He cannot put those shares out into the market. They're not going to be traded for over a year. Um, but essentially, even those that were in pre-IPO, their first window of liquidity is going to be after their Q2 earnings, which is probably going to be in August. So at that point in time, there's going to be about 20% that are available for trade. Um, Thereafter, the release schedule is set and it can only accelerate if the stock is going up. So I do think there is going to be some institutional momentum wanting the stock to go up because institutions, and you may think of different ETFs, we can talk about the indexes again in a moment, but when you think of institutional money managers, they're in the stock already. And they will want liquidity, and to get accelerated liquidity, they will need the stock to go up. I don't think they are going to necessarily violate some fiduciary standard, but I don't think they're going to sell quick. And I don't think they want that price going down. And that's best for investors that are getting in right now, as well as those that have been in and want to get out quicker. So they're going to be aligned on that. And I think they're going to do everything they can to keep the stock high and get it to go higher. Will that happen in day one? I'm not making a call that, hey, this thing's going to pop. I'm very curious to see how it trades today. But I think people need to be mindful of those forces, the fact that, hey, there's going to be more liquidity coming out. At some point, we essentially hit a cycle in which every 15 days, about 7% is coming off and is unrestricted and is available. That, in theory, should be a bit of a pressure point on the price continuing to go up. But the first, 30, 60, 90 days is going to be really fascinating.
And I think additionally, it's creating some questions about what passive investing really means and what
Yep.
you own in your index, which is extremely relevant since passive funds, those that track indices, now account for more than half of what investors own. And so this isn't a SpaceX point initially, but just to tee it up, index funds are more active than you think. Some of the most popular S&P indices, like the 500, require companies to be profitable before they're added, whereas Russell and many other total market benchmarks will include unprofitable names as long as they're big and liquid enough. Some allow IPOs early, some make them wait. And you own different things depending on which index fund you choose and which version of the index it tracks. So, South Korea this year is an excellent example. That stock market has about doubled this year.
Yep.
One index provider, MSCI, treats it as an emerging market, and one, S&P, treats it as a developed market. So, if your emerging markets index fund tracks the MSCI, you're up about 23% this year. If it tracks the S&P, you're up about 11. I'm not saying that's purely the difference between South Korea and not,
But
but
it's a
South
huge
Korea
factor.
is a huge factor as it's doubled this year. So now that gets us back to SpaceX. Index providers, given how large of an IPO it is, and we have some other large ones following, had to a decision to make. And so Russell and NASDAQ both rewrote their rules to fast track SpaceX into their indices, while S&P largely stuck to its traditional approach. So Russell now allows very large IPOs to enter its indices after just about 5 trading days. So a mega cap like SpaceX will show up almost immediately. NASDAQ did the same thing. And S&P kept its long-standing rules for the S&P. For its flagship indices like the 500, an IPO generally has to trade for about a year and meet profitability criteria before it can be added. But it did relax its rules for certain total market benchmarks, allowing faster inclusion. So, depending on which S&P index you own, you may or may not get it. So, what does this all mean? If you think you just own the market, I think this is the moment to realize you're actually owning someone's definition of the market.
100%, man. That was a great point. And even for what it's worth, even on, I want to take your South Korea component a little bit further because the reality is, even the South Korean index, if you isolated that, whether you view it as international developed or emerging, it's being driven basically by two companies this year.
Right.
And you have to know what you actually own, because otherwise it would be a broad uh, and incorrect, I would argue, generalization to say emerging markets are absolutely crushing it. Look at this. If in reality, what you have is a developed market with two companies that are doing really well and skewing that. That style box creep When you think of a style box as an investor, traditionally you think, is it domestic? Is it international? Is it large cap? Is it small cap? Is it value? Is it growth? All of these things, but keeping an eye on kind of index creep is a real thing, and recognizing that, if SpaceX were to, um, just go absolutely bananas and be up 50% in a week, the S&P total market index that may include it is going to have a real different return than the S&P 500 return, because this would be a very large component of it that is up a ton.
Yeah.
And another measure won't have it and it won't move.
Yeah, and I mean, you could get to a situation with South Korea, which again has doubled this year, where based on the indices that you choose, if you mix and match providers, you may not own it at all in a passive
Yep.
portfolio, or you may
Yep.
own double it, and now, which you're talking about is driven by two stocks, and you have an unacceptable level of risk in the portfolio. So passive isn't really passive. You have to make choices about which indices to track and in what weight, which can be hard for individual investors. And I think this, SpaceX is another, kind of clear example of that. You tracked up Nasdaq, which I don't see a lot of portfolios, by the way, where they're indexing to the Nasdaq.
Yeah, no
Um,
thanks.
no thanks. It's going to be different than the S&P 500. One's going to be a forced early buyer. Another one will own it quickly through market exposure. The S&P will sit out and wait. And so depending, you own the S&P 500. That could be your entire portfolio, um, as some people do. And you think, well, look at this SpaceX IPO. I own the market. I must be killing it. And you don't even own it. Or you could be in Russell. The SpaceX is a big component. You don't like how it's performed. You're kind of glad you don't own it because it's not profitable yet. You don't like the trading activity, and you realize, man, I own more of this thing than I thought. So,
Yep.
um, always important to know what you own and to realize passive isn't just passive.
This is a silly example, but it's unrelated to SpaceX, and I think maybe it'll resonate. But we gave a presentation, kind of a pitch to an educational based nonprofit. We'll put it that way, and they were very into us having a mind for socially responsible investing. We don't want to own, these companies that we as a committee have deemed to be, bad for the environment, bad for people, whatever it may be. And the irony was everything they held was essentially broad market passive ETFs. So part of our presentation was, here's how much you actually own of these companies that you say you don't want to own. And
Yeah.
just so we're clear, and we're not saying you should or you shouldn't, but there's a misalignment of values here. You don't want us, if we take over, to buy these companies. Well, you've got, and it was like 11% of the portfolio was in names that they specifically did not want to, and they did not know it.
I've had
And
conversations like that with investors historically who sometimes don't want to own China,
yeah,
and and we point out you own China through
yeah,
your 401k in this
yep,
fund at 10% or 11%
yeah.
or whatever. And so, yeah, and I can sympathize with investors because to go underneath the hood of these vehicles takes time. You probably have a bunch of holdings, but you should know what you own. And in particular, these days, I think it's important to know which index you own and why, or which index your advisor has chosen for you and why. So we wanted to chat about residential real estate to close out. I think we're both somewhat concerned with residential real estate, although there are pockets of the market where it is softening and it is better to be a buyer than a seller. There are pockets of the market, like here, where it's still a seller's market because of tight inventory. I think we're surprised that the real estate industry hasn't impacted the economy more because we're not building as much as we should. Um, and I saw that Warren Buffett, well, not him, but Berkshire Hathaway made a large purchase of a real estate developer. And so, is that calling the bottom on these on the real estate industry, on the real estate stocks? What are your thoughts on where we are with home prices right now?
I would say, with true admiration for what Berkshire Hathaway has been able to do, I don't think it's a bad sign for the housing market that they are making that acquisition. I don't know that they think they're necessarily calling the bottom, but they're certainly saying, okay, well, this is a pretty attractive opportunity given the state of things, and things will turn. Um, for me, the thing that I've been looking at more broadly um, lately has been even just looking at mortgage applications. There was a strong theory in 2022 and 2023, and we talked about it. We felt like it was a factor, and we were flat out wrong about it. But there was an element when interest rates really started to spike, and all of a sudden you went from a 2.5% mortgage rate to five, six, seven, even. There was an element where we felt like, well, we got to get through this sticker shock, and we've got to get through. People have to retrain themselves and recognize that mortgage rates are where they are, and the housing prices probably need to come down a little bit. Well, the sticker shock was there. It was a real thing. People were pretty stunned. A number of people delayed home purchasing decisions, but we're still largely at the same rate that we were seeing there, possibly even higher, depending on what specific time period you were looking at. We might be higher now, and we are not seeing corrections and a rise in reentrance. We will get weekly data periodically in which mortgage applications are high. I would encourage you, if you want to know the state of housing uh, in your immediate area, talk to a closing attorney
Hmm.
and see how busy they are. I've got two buddies that are real estate closing attorneys, and got to tell you, they're playing a lot of golf. Um, and I'll have to send this to them so you can get new subscribers. And if you haven't already subscribed, what are you doing? But they've got a lot of downtime. They are not busy. And I've seen periods in which those guys are absolutely slammed, back to back to back closings, all day long, pushing paper, getting signatures, notarizing, running out of ink in their notarization stamps. They're so busy. They're not there. If you look at the Mortgage Bankers Association has kind of a composite index that they put out. And for context, in isolation, this number may not make a lot of sense, but the number right now is 259.4, which is a combination of rates, activity, refinancing versus new mortgage applications, all of these things. They blended into a number. We're at 259. Even at the beginning of this year, we were at 350. That's a significant decline from even where we were at the beginning of the year. And I wouldn't have said that the housing market was incredibly strong at the beginning of the year. When you go back and you look at, well, where has this number been at times? It's been over 1,000 in the last 5 years. We are very low. The activity is very low. The shelter component of CPI, which is kind of what keeps this top of mind for me, I think continues to be overstated. I think the annual rate is still around a 3.4. There's just not data that suggests that it's going that well. And so I'm incredibly we every week I feel like there's more data that implies the real estate market is having a hard time, and it seems to be incredibly undercovered. No one's really talking about it, focusing on it. And at the same time, I'm kind of glad that the economy has been incredibly resilient through this. I think that's a positive sign. If you think the economy is really bad and housing's great, I would probably argue with you on both points. I think
Yeah.
it's they know the economy is actually pretty good and housing's pretty bad.
What's your takeaway for individuals, whether they are in the market to buy or sell a home, or whether they're thinking about their portfolio and the economy?
Yeah, I think if you're thinking about relocating or purchasing a home, my thought on this is pretty simple. It's always, do you want the home and can you afford it? I don't really care what other people are doing, especially a primary residence. It's could you make money on it? Yeah, you probably will. Long term, housing appreciates slightly more than the rate of inflation over a full human's life cycle. Will you make money on it? Statistically, probably, but that shouldn't be why you're buying your primary residence. Um, I think you should just be thinking about, can I do this? I think if you are waiting on a real market correction, you need to be and if you really subscribe to what I'm saying and you're saying, hey, the bottom's about to fall out, I want to wait a little while. Well, just recognize that may also impact the price of your existing home.
Yeah.
Um, those things are true. And it sounds weird, but in some ways, I would rather you sell your house for less than you can think you can get it for. And if you're moving up the chain, getting a bigger house, nicer neighborhood, whatever it may be, if on scale you're able to acquire that home at a similar percentage of discount to where your expectation was, that's actually a good trade. You might not have squeezed out everything you wanted in selling your house, but uh, hey, you got this one for just as cheap on a relative basis, that might be a good economic situation for you. So I think if you are looking to sell right now, I think you need to be very aware that it is a different dynamic. You are probably not going to get multiple offers over asking, and it's probably going to take a little time.
Yeah, I think for me, keep track of inventory levels in your area. Here in the Northeast, prices are still high because inventory is really tight. If inventory picks up, I would expect prices to soften, and that's what's happened in other parts of the country. So, depending on where you are, keep an eye on inventory levels if you're a buyer or you're a seller. If you're a seller, you want to get ahead of inventory picking up. If you're a buyer and inventory is really tight and you don't have to buy that home, maybe you can wait, particularly if you're not selling or in a huge rush. Two, I would say, and there are break even calculators that you can use. Make sure you're going to be staying in this home for a while, particularly if you feel like maybe you are chasing price a little bit. I shared an article that here anyway. Zillow forecast a break even point for real estate purchases versus renting in mass at 14 years. That's a long time. I would have said, usually I like people to be in their house 7 to 8, 10 years.
Yeah,
Check, make sure you're committed to the area, particularly if it's a place where you're chasing price a little bit. So those are two things I think I would focus on.
I like that. Yeah, the 14 years. I mean, I think the average stay in a single family home is like 6 years.
I don't think I've lived in a house for 14 years. This is the
I think
closest. This is the closest I've come, and we're still in year 13.
I might be off on this data, but I think the average is 6. And if you think about, I think of like my parents, I'm like, well, they've been in their house forever, and they're part of that 6 year average. So, so
Yeah,
for every set of David and Ann Hall that you have that have been in a home for coming on 20 plus years, there's a lot of people that are in one for 2 or 3 to offset that and get us to an average that's in the mid single digits.
absolutely. All right, buddy. Have a great weekend. Remember, check
Awesome.
out Andrew and his team. Please like and subscribe to the video, and I will talk to you next week.
Thanks, man.